Well, the Federal Reserve is expected to declare this afternoon that the recovery is underway. Ira Jersey is head of U.S. interest rate strategy at RBC Capital Markets. He says the Fed may also mention its mortgage purchase program. He joins us now with a preview of the Fed announcement and accompanying statement. Welcome to you, Ira.
Thanks, Lori.
All right, so what is the most important thing the Fed needs to do today? Is it characterize the economic outlook? Is it talk about its interest rate strategy or the exit strategy or all of the above?
Well, I really don't think that they're going to reiterate much about their exit strategies. I think that, though, that they will, there's a 50-50 chance in our view that they'll probably mention the mortgage purchase program ending, because at the current pace, it will end by the end of the year, and you don't just want to go cold turkey on this one, because the Federal Reserve is purchasing more than 100% of the supply of mortgage-backed securities, so they can't just go cold turkey. The market won't take very well to that.
So any chance that they'll extend that, or if we don't get a lot of details at this meeting, will we hear more at the next meeting? Because a lot of people want to know what the Fed is going to do with this ginormous balance sheet.
Well, I really think, well, we talk about the balance sheet in a second, but as far as the mortgage purchase program goes, I think that firstly, they will wind down the program incrementally, similar to what they're doing with the Treasury purchase program, but they'll do it over a more extended period of time. I don't think, though, that they will go beyond the $1.25 trillion that they said that they're going to purchase.
Any chance that they will finally confirm that we are out of a recession, or are they going to go more like what Chairman Bernanke said, and we're likely out of a recession?
Well, I think without seeing the actual numbers, that you have to say something like likely, or we believe, or we see signs that the economy is improving. I think they'll reiterate Chairman Bernanke's statement that we are likely out of the recession. We do believe that we are out of the recession. The issue is really, where is forward growth going? Our expectation is for growth over the next couple of years to be very slow, although positive, but not enough really to bring down unemployment very significantly, which is really what policymakers have to be cognizant of, and one of the reasons we think that the Fed's policy will remain very accommodative over the next several years.
Okay, so getting back now, let's readdress the balance sheet.
Sure.
You know, there's a lot of talk about the repos, right? That might be something of a temporary measure to sop up some of the liquidity. This needs to be done in a slow manner because there's a lot of perhaps experimentation going on. So how do you see the next couple of years into next couple of months into the end of next year panning out?
Well, I think firstly we have to remember that there is a lot of roll-off of the Federal Reserve's balance sheet. By our calculations, about $300 billion, so more or less about a quarter of what the Federal Reserve has added to its balance sheet over the past 18 months, rolls off by the end of 2010 if the Fed just stops purchasing anything. So you get about a quarter of the accommodation done without doing anything at all. That's similar to a hike. And then on top of that, if you do reverse repurchase agreements because you need to effectively remove that accommodation faster, they will have the capacity to do that. They always have. It's just that some of the technical issues have been talked about over recent days.
How long can the Fed keep this benchmark interest rate at its level it's at now?
Years. It could really keep rates this low for this long. For one thing, really the household sector needs to delever. And as they delever, they also need to roll over debt that they have. So being able to do that at lower interest rates will allow the household sector to get more money out of what they're currently earning. So if you take, for example, what you make, you subtract out taxes, you subtract out interest payments, then if you're left with a bigger piece of that pie, that's really where growth is going to have to come from, because we don't think wages are really going to go up as employment remains high and companies are really worried about their margins.
This labor issue is a big problem, right? We talk about the fear of disinflation. There's such slack in the economy, right? Companies don't have a lot of pricing power. Will these millions of people without jobs be able to assume positions within this slack, or is it going to have to come to new innovation or ideas? How will the Fed address this today?
Well, I'm not sure that they will address it today. I think they would
talk about the labor market now.
Well, they will talk about the labor market and the slack in the labor market more likely. And I think in the minutes in 2 weeks, they'll even just address that more clearly. But really, the employment situation in many ways is more of a fiscal issue. So more for Congress. Will there be other fiscal measures? Will the fiscal stimulus that is really starting to hit now help enough in the employment situation to really get the economy going? We're not convinced that it will, but that certainly is the hope of the government.
Ira Jersey, the head of U.S. interest rate strategy at RBC Capital Markets, joining us on set. Ira, thank you so much.